Video will be on how to complete parts A and B of problem 6-3B in your textbook. The problem is listed through Wiley Plus. You can access it through chapter 6 and then go to the problems and then select the problem set A and scroll down until you see problem 6-3B, or you can go to the
page 313, problem 6-3B. We're going to go ahead and read it. Collins Company had a beginning inventory on January 1 of 100 units. So our beginning inventory is going to be 100 units. And the costs will be at $21 per unit. During the following, they made a purchase on 3/15, 300 units at $24 per unit. They made another purchase on July 20th, 200 at $25 per unit. Then on September 4th, we went ahead and bought 300 more, and this time the price jumped up to $28. And then finally December 2nd, we purchased 100 units at $30. So what I would like to do is I'm only going to answer questions A and B for this one. So what I would go ahead and do is I would calculate, let's say 2100 here, and we'll have 24 times 300, so 24 times 300 units, that's 7,200. That's 2,100 up there. Then 200 times 25, which is what, 50, and then add the 2 zeros, so that makes it 5,000. And then 300 times 28 is 8,400. And then finally 330 times 100, which is 3,000. We're going to add them all up. 2,100, 7,200, 5,000, 8,400, and 3,000, 2,570. And this number represents cost of goods available for sale. So if you take your beginning, add all of your purchases, so the cost of goods purchased, that will give you your cost of goods available for sale. Alright, and that would be the answer to item A. Then for item B, it says determine the ending inventory and the cost of goods sold under the following method. So what I'm going to do is I'm going to do the FIFO method first, and I'm going to do the LIFO method, and then the average weighted average cost method, or average cost method. Okay, now before I do that, I need to know how many on hand. Well, if we look at how many units we had available for sale, we add up the 100 plus the 300, that's 400 plus the 200, that's 600, 600 plus the 300, that's 900 plus another 100, that's a grand total of 1,000 units available to sell and valued at, or costing us $25,700. So if we have 1,000 units available, and the problem told us that 700 units were sold, then that would mean 300 would have to remain on hand. So whether we're using FIFO or LIFO, we have 300 units on hand. So 300 units on hand. And when we say on hand, we basically mean 300 units in our ending inventory. Okay. under FIFO, first in, first sold. So that means the last items remain on hand. So if it's the last items that remain on hand for FIFO, we're going to start with the last date, which is 12/2, and we're going to account for 100 units. And then we're going to go to 9/4, and we need a grand total of 300, right? So if we need 300 units and we're only at 100, let's see, we would need 200 more. Okay, so that would give us 300 units for our ending inventory. So the 100 purchased on December 2nd would be $30, and the ones purchased on the 4th would be $28. So we'll extend the price out. So 100 times 30 would be 3,000, and 2 times 28 would be 5,600. We'll add it together, and that's 8,600. And what does this represent? This is the cost of ending inventory. So what we'll do is we'll take our cost of goods available for sale, which is 25,700, plus our ending inventory, which is 8,600, and that will give us $17,100. And we'll call that our cost of goods sold. And this would be the answer for FIFO. Alright. And I'm going to kind of separate this because I wrote a little too big. Now, LIFO, last in, first sold, would mean the first items are in ending inventory. So that means that we will use the dates that are first. So we'll start with the beginning inventory because that's earlier than our first purchase. So the beginning inventory, which is January 1, we'll start at 100 units at $21. And then our next purchase date would be March 15th, and that would be 200 units. We don't want to use the full 300 because that would put us over our 300 units that we have on hand. And that price would be $24. So we got the 24, and then we got the 21 here. So we'll figure out what the cost is. So 100 times 21 is 2,100. 200 times the 24 is 4,800. So added together, that's 6,900. And that represents the cost of ending inventory. So we're going to do cost of goods available for sale less ending inventory. So cost of goods available for sale, again, it doesn't change. 25,700 minus 6,900. 25,700 minus 6,900. So it would be 18,800. 18,800. And that would be our cost of goods sold under LIFO. Okay, and let me, sorry, too big. Alright, and the last one, average costing. Again, we have 300 units, and that means that we have 700 sold. So ending inventory is 300, sold is 700. So what we want to do is get our weighted average cost. To do that, we're going to take our cost of goods available for sale divided by units available. So that means our cost of goods available for sale is 25,700. Number of units available is 1,000 units. So our weighted average cost equals $25.70. $25.70. So we'll take the 300, multiply it by the 2570, which will give us 300 times 2570. That's 7,710. And that will be our ending inventory cost. Then we'll take the units sold, 700 times the 2570. And of course these are dollar signs. Get in the habit of labeling your amounts. So 700 times 2570, that's 17,990, and that's our cost of goods. So, alright. You'll notice that your cost of goods available for sale plus your ending inventory, your cost of goods available for sale minus your ending inventory will always give you your cost of goods sold. So we could have just as easily, as an alternative, we could just taken average cost method, and we could have started with cost of goods available for sale, 25,700, so 25,700 less our ending inventory of 7,710, and that would still give us a 17,990 for our cost of goods sold. So that's A and B. Any questions? Post in the discussion thread.